You ever get that feeling that the whole financial world is, well, a game? A game where you're a player for sure, but you definitely don't know all the rules. The thing is, you're right. It is a game. And we're about to lay out the 5 biggest rules they really don't want you to know. So, let's learn how to play, shall we?
Now, I know that sounds harsh, right? But it cuts right to the heart of the bank's business model. It's not that they're just hoping you make a few financial slip-ups. Their entire profit structure depends on it.
Now, understanding this isn't about getting angry at banks. Not at all. It's about understanding the game board, the system, so you can finally start using it to your advantage instead of letting it use you. So let's pull back that curtain.
Okay, let's dive into rule number 1. This is the big one, the most important rule of all. The entire banking industry, I mean the whole thing, is built on selling one simple product, debt. And to them, your debt, well, that's pure uncut income.
See this number? 25% APR. To a bank, this is a beautiful thing. It's their dream scenario. When you swipe that credit card for something you can't quite afford, it might feel like they're helping you out. But what's really happening? They're locking you into a high-interest product that is just unbelievably profitable for them. And believe me, they have done the math down to the very last penny.
And this is where the game really gets wild. The average American household is carrying over $6,000 in credit card debt, paying around 25% APR. That interest is like an anchor, just weighing you down. But what if you flipped it? What if that same 25% was working for you? Suddenly, it's not an anchor. It's a rocket engine for your wealth, not theirs. And this number right here, this shows you just how high the stakes are. If you took that same $6,000 and invested it, and let's say you earn 25% a year for 45 years, it could grow to over $130 million. Now, this isn't some fantasy math. This is the raw power of compounding that the banks and credit card companies are using against you every single day. So that's how they make a killing on your debt. But what about the money you're trying to save? You know, the money you think is just sitting there safe in a vault somewhere? Well, rule number 2 is going to reveal a pretty shocking truth. Your money isn't where you think it is. So you walk in and deposit $100. You think the bank just holds on to it for you, right? Wrong. To them, that money is a liability. So what do? They immediately turn around and lend out most of it, say $90 to somebody else. That person then spends it, and that $90 gets deposited into another bank, which then lends out 90% of that, and on it goes. Your initial $100 is actually used to create hundreds of dollars of new money out of thin air. This whole process, it has a name. It's called fractional reserve lending. And you need to understand the entire modern banking system is built on this foundation, this idea of lending out way more money than they actually have in their vaults. So you can see this whole gigantic structure is built on one thing and one thing only: confidence. The system only keeps working as long as all of us don't show up on the same day demanding our cash back. Because if we did, the whole thing would collapse. That's exactly why things like FDIC insurance were invented, to stop bank runs and keep that fragile confidence intact. This whole fragile system brings us to rule number 3, and this one is all about the people you trust for financial advice. You might see them as an advisor, but you really need to understand what their job actually is. You know, there's an old saying in business: never ask your insurance salesperson how much insurance you should get, because what are they going to say? The answer is always going to be more. Well, the exact same logic applies to your banker. Asking them how big of a loan you can afford is like asking a car salesman how much car you should buy. I mean, just think about their incentives for a second. Their job is to sell money, plain and simple. They often work on commission. So the bigger the mortgage, the bigger the car loan you take out, well, the bigger their personal paycheck becomes. Their legal fiduciary duty is to the bank's bottom line, to its profitability. It is not and never has been to your personal financial well-being. All right, rule number 4. This one challenges the single biggest financial myth we're all taught. We're told from the time we're kids, save your money in the bank and you'll build wealth. The reality? Saving your money is a guaranteed way to lose the game. Let's just look at the raw numbers. Over the last 5 years, if you did the responsible thing and put $100 in an average savings account, you might have ended up with about $105. It feels like a win, doesn't it? But in that same period, the reported cost of living shot up by 23%. So that basket of groceries that cost you $100 5 years ago, today it costs you $123. And that is the trap. Yeah, on paper, you have more dollars, but your purchasing power, what your money can actually buy for you, has been crushed. And this is the key takeaway. You simply cannot outsave inflation. It's impossible. Saving is great for emergencies, absolutely. But to actually build real wealth, you have to invest.
And that leads us perfectly into the fifth and honestly, the most powerful rule. This is where you learn how to stop being just a pawn in their game and you start owning the whole damn board. It's time to flip the script.
This right here, this is the ultimate mindset shift. The entire system is designed from the ground up to profit from two kinds of people, debtors and savers. But the secret the wealthy have always understood is that you don't have to be either one. You can be an owner.
Just look at the difference here. As a saver, the bank might graciously give you, 0.5% in interest each year? But as an owner of that exact same bank's stock, you can earn an annual dividend yield of 2.4%, 2.8%, maybe even close to 5%. You're not collecting pennies in interest anymore. You're collecting your rightful share of the profits.
And what is a dividend really? It's simple. It's a cash payment. It is your slice of the company's profits sent directly to you just for being an owner. That's it. It's the reward you get for owning a piece of the game.
This is the fundamental secret to creating real wealth. It's not built by hoarding cash in a savings account that's constantly being eaten alive by inflation. No, it's built by owning assets, things like companies, stocks, real estate, that actually generate real profit.
So, let's just wrap this all up. The banking system profits from your debt and from your savings just sitting there. Inflation is like this silent thief that makes saving a losing game over time. The only way to win is to become an owner, so you can profit from the system. And that requires a deep, fundamental shift in how you see yourself, not as a consumer, but as an investor. Which leaves us with one final, very important question. Now that you know the rules, you've got a choice to make. So, are you going to keep playing their game, or are you ready to start playing your own?